Welcome to The Explainer. Today, we're popping the hood on a regional banking powerhouse. We're breaking down BankUnited's second quarter 2026 financial results. Now, understanding these mechanics doesn't just tell us about one single company. It actually gives us a really crucial window into the overall health of regional banks and, honestly, the broader economy right now. We're going to look at exactly how a modern bank operates when it manages to pull off record-breaking deposit numbers while simultaneously expanding its profit margins in what we all know is a pretty complex economic environment. Think of a bank like a high-performance vehicle, right? Deposits, they're the fuel. The loan portfolio, well, that's the engine. Today, we're going to see exactly how BankUnited is tuning both of those for absolute maximum efficiency. Let's dive in.
To make sense of this financial engine, we're going to follow a quick four-step framework. First up, Q2 earnings and profitability. Second, the power of deposits. Third, strategic loan portfolio shifts. And finally, managing credit and risk.
All right, let's kick things off with part one, Q2 earnings and profitability.
Boom, right out of the gate, we've got a really punchy metric that totally sets the tone for everything else, 97 cents. BankUnited reported a diluted earnings per share of 97 cents for the quarter, and that is actually up 7% compared to a year ago. Now, in the banking sector, a 7% year-over-year jump in EPS, that is a massive signal of bottom-line strength. It tells us immediately that whatever they're doing behind the scenes, it's translating directly into real shareholder value.
So looking beneath the surface just a bit, net interest income hit $255 million. But honestly, the real star of the show here is the net interest margin. It expanded to 3.06%. That's up 13 basis points from a year ago. And as a quick refresher, when a bank's margin expands like that, it means they're earning more on their loans than they're paying out on their deposits. That widening gap, that's the primary engine driving that really impressive 97-cent EPS we just talked about. Moving right along to part two, the power of deposits. Okay, to really grasp this next part, we need to break down a critical piece of banking jargon, and that is NIDDA. It stands for non-interest demand deposits. Put simply, this is the cash held by the bank in checking accounts that pays absolutely zero interest to the depositor. For a bank, NIDDA is basically the holy grail. It is highly cost-effective funding. Think of it as essentially free fuel to power their loan engine.
And that brings us to this crucial number right here, 34%. An incredibly impressive 34% of BankUnited's total deposits are completely free of interest expense. Just think about that for a second. More than a third of the money they use to fund their operations and issue interest-bearing loans costs them absolutely nothing in interest payments. Zero. That is huge.
This dynamic creates a massive comparative advantage. Check this out. BankUnited actually grew their free NIDDA fuel by 11% from the prior quarter. That's an increase of nearly $1 billion. And at the exact same time, they intentionally shed their expensive, interest-heavy brokered deposits, dropping those down to just 10.5% of their total deposit mix. So they're actively stockpiling the cheap fuel while deliberately cutting off the expensive funding sources. This right here is exactly how you drive your net interest margin up to that 3.06% we saw a minute ago.
Now, let's do a quick so what check, right? Where is all this highly coveted cheap fuel actually coming from? Well, it turns out it's incredibly diverse and highly stable. They've got a massive $4.9 billion coming in from National Title Solutions and another $2.4 billion from National Homeowners Associations, or HOAs. You see, this isn't flighty money chasing high yields. These are operational accounts for businesses that literally need to park large sums of cash just to run their day-to-day operations. So it proves this cheap fuel is sticky, it's diverse, and it's extremely reliable. All right, let's shift gears to part three, strategic loan portfolio shifts. Which naturally brings us to the big question, right? Where exactly is BankUnited lending its money in this 2026 economic climate? As we know, every loan is a delicate balance of risk and reward, and in today's environment, where you place those bets matters more than ever. So, in an era where commercial real estate seems to be making headlines for all the wrong reasons, BankUnited reveals a surprisingly balanced approach. Look at this breakdown. Industrial is sitting at 24%, retail is 22%, office is 20%, multifamily is 17%, and other makes up the remaining 17%. They are not over-leveraged in any single property type whatsoever. This distribution is pretty much the visual definition of not putting all your eggs in one basket.
But of course, a portfolio isn't a static thing, right? It requires constant tuning.
And while their average core loans increased by a really solid $196 million quarter over quarter, they simultaneously executed $237 million in strategic loan exits. So what does that tell us? Well, it tells us they're actively shifting away from riskier segments that they just no longer want to be in. So while average total loans are holding steady at roughly $23.8 billion, the actual quality and composition of that $23.8 billion is being actively upgraded. They aren't just revving the engine, they are really fine-tuning it.
And that diversification, it extends geographically as well. The commercial engine leans pretty heavily on their home turf of Florida at 29%, which is matched equally by non-depository financial institutions, also at 29%. From there, we see some really healthy spreads across Georgia, Texas, North Carolina, and the New York tri-state area. By spreading their commercial lending across all these different robust economic regions and financial sectors, they're further insulating the engine from any kind of localized economic shocks.
Let's move on to our final section, Part 4, Managing Credit and Risk. To fully understand how they defend this whole setup, we need to translate one last critical banking term, and that's the ACL. It stands for Allowance for Credit Losses. Simply put, think of the ACL as a massive rainy day fund. It's a reserve of money explicitly set aside on the balance sheet to cover any estimated potential losses in the loan portfolio. The larger the ACL relative to total loans, well, the thicker the safety net. Tracking the drivers of change here, we can see the total safety net was pushed from the first quarter up to $217.5 million by the end of Q2. If you notice the additions for specific reserves and the changes in the economic forecast, it's pretty telling. By actively modeling for uncertainty, they increased their ACL to 0.91% of total loans, meaning they are looking out at the economic horizon and proactively adding capital to thicken up that safety net.
But here's where they directly address the market's absolute biggest anxiety right now: office real estate. While the overall ACL is 0.91%, the specific ACL assigned to the office loan portfolio sits at a highly elevated 1.98%. The bank knows full well that office space is the most scrutinized sector in commercial real estate right now, so what do? They've effectively double padded their reserves for this specific portfolio just to reassure the market that they are well protected.
Finally, let's look at the actual realized losses over a trailing 12-month period. Now, yes, the net charge-off ratio has naturally ticked up slightly over the last year. It moved from 0.23% in Q2 of 2025 up to 0.35% in Q2 of 2026. However, when you look at the grand scheme of historical banking metrics, 0.35% remains incredibly manageable, especially when you factor in that robust $217 million ACL we literally just looked at. Bottom line, the defenses are holding firm. Which leaves us with this final thought. We've seen a bank that has totally mastered the art of gathering highly cost-effective deposit fuel. We've seen them strategically fine-tune a beautifully diversified lending engine. And we've seen them build a really formidable defensive safety net with their credit reserves. So the real question is this: with this fortress-like balance sheet, how will BankUnited leverage their position when the macroeconomic tides inevitably shift next? Because they are clearly built for the road ahead, no matter what the conditions might be. Thanks so much for joining me for this explainer, and as always, keep questioning the data.